The software sell-off continues. Is it a buy at this point, or is it a falling knife you need to avoid? Here to break down 3 software names that are a good buy right now and 2 names you want to avoid are Joel Litman and Rob Spivey with Altimetry Research. So glad to have you both back on the show. Always fun to have 2 guests on. Let's talk a little bit first before we get into the 3 names to buy and the 2 names to avoid. Let's just talk about what is happening in the software story. I feel like we've been talking about it for weeks now, but these charts just keep going down, Joel.
Yeah, so, what's been happening, the SaaS-mageddon or the SaaS-pocalypse or whatever you want to call software as a service collapsing is really similar to what happened last year that everyone's forgotten about, right? So last year, there was a big dip in the semiconductor makers, meaning NVIDIA, AMD, and others, because DeepSeek came out from China, scared everyone. They said, oh, this could be done for $3 million. It doesn't cost $3 billion to do this. Later, we found out there's a lot more behind the scenes, that they probably were using a lot of chips that came through Singapore and other things that they were using to build DeepSeek. And DeepSeek has been shown to hallucinate 7 times more. But at the time, it scared everyone and said, oh, if China or anyone else can do this for $3 million and a $3 billion, who needs to buy all these expensive chips? And what happened to semiconductors? They got crushed. Now, look at them today. Despite this SaaS-mageddon and SaaS-pocalypse and everything else, these companies are at all-time new highs. They've done very, very well since that dip. And so certain companies, when you see dips like this, make sense. In this case, we think there are certain firms, there's really a separating of the wheat from the chaff, meaning there are certain SaaS, software as a service companies, that are going to do very, very well coming out of this dip, and there's others that are going to do poorly, and that's why we talk about 3 we like and 2 we'd really, really avoid, because I think at this point, you're going to see much more of a separation.
I think that comparison to what happened with DeepSeek early last year is such a good one, because it's easy as investors to forget what happened in the market, to forget that big downturn, especially when you look at the returns those semiconductor stocks had at the end of the year. A lot of investors made a ton of money who were buying during that DeepSeek dip early in January sometime. And so this is a good comparison. I'm curious to see timeline before Rob takes us into the 3 names to buy. Joel, what are your thoughts on a timeline for recovery? I know with the semiconductor stocks, we had that the tariff issue in April that brought all those names much, much lower. And then it was maybe at the second half of the year when they really started to make that comeback. Could it take that long for these software stocks to recover?
From 1994 to 2000, during the dot-com where NASDAQ went up 600% during the time frame, the stock market fell 10 times for more than 10%, and the recoveries were always within just a few quarters. So we think this is very similar, that we're in that kind of an AI productivity boom, right? It is still a bull market. A lot of these companies, when you look at them under uniform accounting, that's their specialty, because GAAP accounting doesn't pick up companies correctly. These are a lot healthier companies at lower valuations and really, really strong earnings. Nothing like the end of the dot-com bubble. And so for that reason, you're talking quarters, not years, for this kind of recovery.
Yeah, that's my favorite thing about having you guys on. Altimetry Research is all about the accounting angle on looking at companies, a really deep dive into the fundamentals of the company, into the numbers. And that's what Rob's going to do for us, sharing these 3 stocks to buy right now on this software dip. And then Joel will take us into the 2 names to avoid based on, again, their fundamentals, their numbers, just looking at their spreadsheets. That is what Altimetry Research does. Again, if you want to take a look at this company, these are the kind of names these guys look at all the time with their newsletter, Hidden Alpha. If you want to take a look at that, you can scan the QR code or click the link we have right in the description to follow more from Joel and Rob and their team at Altimetry to really dive into the numbers. If you're a numbers person, this is a newsletter for you. All right, Rob, let's get into the first name. What is the first software stock that you're looking at right now as a buy?
Just to step back, kind of how we attacked this was what we did is we looked at all of the software companies out there. And one, we looked at them from a uniform accounting perspective. And the second thing that we did is we ranked all those 126 companies across a bunch of different metrics to identify, Bridget, whether or not they really are at risk of AI disruption as a SaaS company. We looked at things like, do they own the customer? Are they a system of record? Are there high switching costs or not? Things like, are they actually integrating AI themselves? And do they handle things like authentication and, or are they dependent on others? And the first one is Microsoft, because Microsoft, front and center, if you think about all the things that I just talked about, it is 100% not at risk of AI. In fact, it's at the center of AI, right? I mean, the switching costs for Microsoft are crazy high. It is the statement, it is the system of record for everybody. They're doing a great job in terms of integrating AI from everything that they're doing, and they're aggressively basically being front and center of this. And what's so interesting is, the stock is down something like, I think like 20% or so in the last 3 months. And if you look, Right now, Microsoft, on a uniform accounting basis, when we clean up the accounting noise and we remove all of, the issues around R&D investment, how there's noise in their CapEx investment from the huge investments they're making from the data centers, also stock option expense, this is only a 20 times uniform PE company right now. And when you look at that, for a company that's as dominant as Microsoft is and likely to be one of the biggest winners of AI, that just doesn't make sense. And what's so interesting is if you really get in the weeds, this is what we can do with uniform accounting and why it's so powerful, because we can do this for all 126 companies in the software sector at once. You can look at what the market is expecting earnings growth to be for the next few years and what we think earnings growth really can be. And Microsoft scores incredibly high here too. After the sell-off in Microsoft, the market's only paying for like 6% a year earnings growth from Microsoft the next couple of years. We think Microsoft, on a uniform accounting basis, when we clean up the accounting noise, can do better than 14%. And so that's why we think Microsoft is just a slam dunk right now. We know it's one of the biggest companies in the world, but we want to just recommend everybody, do not take your eye off the ball for this one because it has all the reasons to keep on going up.
It has all the reason to keep going up, and yet it keeps going down. I think that this is where some investors, especially retail investors, are getting a little skeptical because they hear Microsoft as a buy and then it goes down. And then they hear Microsoft is still a buy at this level and then it goes down again. We saw that continued downfall just over the last few weeks. So let's talk time horizon again for this one specifically. How long for that turnaround, Rob?
Yeah, I mean, this is one too. And when you look, Joel made the analogy to the 1990s and the idea that you can see all of these bounce backs happen relatively quickly and within a quarter or two once people put their eye back on the ball, as opposed to getting extremely concerned about the artificial narrative that AI is going to wipe out everything or anything else. And you look at this for Microsoft, look, as they just continue to post phenomenal numbers for Azure demand, for investment, for other growth in their business, you're going to see this company bounce back very quickly as people realize, oh, no, literally everything that they're doing with Azure. I mean, Azure, for instance, they literally, the only reason they don't grow Azure more than they are growing it each quarter isn't because of demand. It's just because they can't get the data center stood up fast enough. And so once people realize that, which is, less than a quarter of a narrative, this is the kind of stock that can bounce back very quickly.
I think you make a great argument that this is not just a software stock. This is really an AI company. I think this one, the level it's at right now, feels like a very comfortable add to any portfolio. And that is why I want to add it to my Bridget Spies watch list. I try to pick a stock every video we talk about to add to my paper trading watch list on MarketBeat.com. If you haven't checked it out yet, you should. Some of the names that we talk about have gotten beaten down a little bit with all of this downturn, but I don't have Microsoft on it, and I think now is a good entry point. So I'm adding this one to my watch list. All right, let's get on to the second company. I think these are also an interesting name to be looking at right now.
Yeah, and this is AppLovin. And for those of you who don't know AppLovin, we know the name is absurd. But what it actually does is it is the key marketplace network for placing ads on mobile phone apps. And what's really interesting is it's also a great example of what's going on right now in terms of narrative overtaking fundamental reality for companies. The last week or two, there came out with a story about somebody who had vibe coded effectively a new marketplace for placing ads on apps. And everybody said, oh no, AppLovin, who their whole entire business is literally being the solution that even Microsoft and Alphabet and Meta use to place ads on mobile apps, they're going to be disrupted because we've got AI vibe coded solutions. Well, you look at AppLovin, what they do in terms of that marketplace, one, they have better data than anyone else does, which is an incredibly important thing when you want to be able to defend yourself with an AI moat, to be able to say, hey, we've got data that you can't analyze with your AI because you don't have it, only we have. Also, they are deeply integrated in terms of using AI already to do better placement in terms of their people who are buying ads and people who are selling space on their apps. So they get a better return for every single part of the ecosystem that you can if you don't have their data and you don't have their AI solutions already. And so this company has dropped more than 30% in the last few months. But you look at it, and now this company is trading at a 22 times PE when, because of how strong the growth rate is in mobile, digital, in app ads, this company is going to have 64+% earnings growth a year the next couple of years, and the market's only paying for 20% earnings growth, which is the kind of setup that you get when the market totally overreacts to this kind of narrative because they say, oh, AI is coming, DeepSeek is coming for NVIDIA, AI vibe coding is coming for, this platform business. It's just not happening. And that's what makes it such an exciting opportunity for us, for AppLovin.
Yeah, this is an interesting name, especially the argument you make about mobile and apps continuing to grow. That growth rate is definitely exciting. And I know that you guys are about the numbers and the fundamentals, but we also like to look at what analysts are saying. And I think this qualifies for this company and the three names that you have on the buy list right now. Analysts are still very bullish on this. The projected upside for these stocks is wild. And some of those analyst price targets are recent. Even after this software storm that we've seen the last few weeks, they're still bullish on the future. So it's not just you, it's others too. Do you think that this one has the same time horizon as Microsoft for that turnaround?
Yeah, this one's interesting because, there's inherently questions about, disruption. But the bigger thing for this company is it is such an opportunity to deliver so much stronger earnings than anyone is recognizing. If the real concern is this theoretical existential crisis for the company, which is what people are spooked about, you see another quarter where as reported return on assets for this business is like 20%, but uniform return on assets is over 100%. And they post phenomenally strong earnings growth another quarter because of just how robust their marketplace is. This is a company that you're going to see intra-quarter even probably people releasing news about how strong things are for them. And as the quarters come and come, this is a company that people are going to quickly realize they're missing the boat on. And when people return to normalcy, the stock's going to be up a lot.
All right, let's get on to the third name that you have for us. And this one is a different name. I think we've covered it once before on the channel, but it's not one you hear a lot in headlines.
Yeah, and so this is Intuit. When you think Intuit, most people don't think Intuit. They think either TurboTax if you're an individual, or you think effectively everything they use for QuickBooks, right? QuickBooks, which is the accounting platform of choice for any small businesses. And so everybody's been looking at them over the last few weeks as you said, oh, hey, you've had, again, these vibe-coded solutions to be able to optimize for tax strategies. Are you really going to give your social security number and all your financial information for the last 3 years to a vibe-coded solution to do your taxes for you, as opposed to actually using Intuit TurboTax? Of course you're not. And on top of that, Intuit TurboTax has all of these different integrations. It's not getting disrupted. It has that idea of basically owning the authentication layer and owning security, and it is so hard to change off of that platform. Same thing with QuickBooks, right? People are like, oh, people will be able to vibe code the ability to do a simple accounting software like QuickBooks. Are you going to feed all of your financial information? Are you going to get rid of all of the integrations you have with payment solutions, invoices, and everything? That's just not happening. And so this idea that, Intuit, which is down literally over 40% the last few months because of this worry about the SaaS apocalypse, it's just not going to happen. And so we look at this, and the really interesting thing is people don't quite understand how good of a business Intuit is. On an as reported basis, this company has like an 8% return on assets, really low profitability. So people go, yeah, it's not that strong anyways. It could be disrupted. In reality, corporate average return on assets is around 12%. This company has a 60% return on assets. That is 5x corporate average. It's a really strong company already, and it's not going anywhere. And look, after that drop, again, 40% in the last few months, it's trading at a 16 times uniform PE, and the market's basically pricing it for no earnings growth, where this company is throwing off 10+% earnings growth a year as one of the most durable moat businesses you can find. That's why this one is not yet a name that we recommend on Hidden Alpha, but we are paying attention to this one closely and maybe recommending soon because it just seems like such an obvious setup.
Yeah, what an interesting company, and an argument too about this is an area because of security that AI is probably not going to be filling this role at least as quickly until really many companies change the way that their comfort level with AI and giving them that kind of information. And I don't see that happening anytime soon, kind of like you said. I do think one question with Intuit is this is a very competitive space. You mentioned a few other names that are more long-standing companies that have more name recognition. What's the competitive edge for this company?
Yeah, and the big thing for Intuit is the whole entire ecosystem that they offer for both consumers and for corporates, right? When we think about the consumer perspective, the integration they have between TurboTax, between payment options, between their solutions that basically help you track your credit risk. And it's the fact that all of these different things and the way that you basically can budget, right, using their solutions, it's the way that all these interact. Once you're on the Intuit platform, there's really high what we call switching costs. The effort to be able to move off of that is really hard. And then on the flip side, when you think about it from a corporate perspective, also same thing. Once you're on QuickBooks, you have already standardized on how you're invoicing people, how you accept payments, because you have QuickBooks integration for payments. You're now handling that whenever you're sending over your tax forms. You're going to have to move all of your financials for the last 5, 8, 10 years off of this one platform onto a new vibe coded platform, there's really, really high switching costs for Intuit, not just the securities costs, and really good integration that they have as being, and this is the idea, they're a platform that other people have built APIs into and tools, third-party tools on top of. That mean once you start using those third-party tools, the idea of going onto a limited opportunity solution on the other side, you're just not going to do it because it's just too much of a high effort. And that's what makes it so durable that people are totally sleeping on. Again, with the stock down 40% and a uniform PE of 16 times.
Definitely a competitive edge for Intuit. Again, it's not a name you have on Hidden Alpha, but there are other really interesting names to look at in software and other sectors as well. If you want to check out Joel and Rob's newsletter, make sure to scan the QR code or click the link in the description of this video to check out more from Altimetry Research and the kind of numbers that they're giving. Joel, it's now your turn to get into some of the details on the two names to avoid. And I don't know about you, but I feel like this is just as important as the names to look at as a buy right now, or which ones you want to stay away from, right?
Wall Street right now, as of right now, is 95% buy and hold. So the stock market is at all-time highs, and if you look at every one of the ratings from all the 50 biggest investment banks, it's 95% either buy or hold. I don't know what to do with that kind of information. So we're kind of famous for the fact that, and unfortunately, being the bearer of bad news, that we probably have more stocks on our do not buy list than we have stocks on our we actually think you should buy. And in this case, we have two that I want to mention. One is, and it's the same thing, they have dropped, both of them are down 35 to 40%. And despite their price being down that much, their price to earnings under our uniform numbers are still both 65 to 70 times after having fallen 35 to 40%. And what we don't like about them is everything that's the opposite of what we like about the longs that we recommend. The first one I want to mention is HubSpot. So in the CRM world, customer relationship management, there are companies that have high switching costs. There are companies where you load up all your data and then some big enterprise is sitting there saying, I'm not going to move my 70,000 or 1 million customers off this database. I'm stuck with it, right? But HubSpot is for small, medium-sized businesses. And these companies, if push comes to shove and things get tight, they can easily switch and say, you know what? You're a little expensive. I can go with a vibe-coded, if you will, alternative that a gigantic multinational corporation is not going to do. And so when your main customer base is small, medium businesses, it's too easy to lose them. And because of that, we think HubSpot, HUBS, is something you would not want to be buying the dip on by any stretch of the imagination.
Okay, that's really interesting and a great point on software companies that if you've got more of those large corporations, they're slow to change. It takes a lot more to move that ship and turn the ship a little bit. But if your main customers are those smaller companies, changes are quick and easy to make. So I think that's a really strong way to look at these software stocks of how difficult or easy is it for companies to switch from them. What about the service that HubSpot offers, though? Is there still any intrinsic value in that? Or do you think that it is really something that could be more easily replaced with AI?
Well, that's it. Like the other CRM companies, they say, we like to bundle the offerings. Everything you need for your whole sales cycle is encompassed there, but everybody can say that, right? They don't have any proprietary data that does anything special. They're saying, oh, we can give you all these add-on tools. They're trying to provide a one-stop shop, but there's nothing proprietary about their add-on tools. There's no proprietary data or insights or analytics that they're going to provide to some smaller pizza maker or a fabric shop or whatever small business that they're targeting. Those smaller companies, as you said, only have a few hundred customers. That's not hard to move them to a new vibe-coded data set and database and say, you know what, I can get all those tools elsewhere. And that is the issue. Without the switching costs, what's the reason that they can't continue to lose against the AI tools that are coming online?
Yeah, I think this is one good name to look at, but it's also a good concept to keep in mind as you're looking at all of the software stocks out there of how quickly can companies switch from this software to others. I think Microsoft is a great one of software is not the main part of their business anymore even, but of what companies have invested in there, it's going to stick. It's going to be harder to change from. So I think that's a great way to look at all the software names. I know, Joel, you have one more name for us of a stock to avoid right now in this software downturn. Let's get to that last one.
Technology companies, the earnings number doesn't represent reality. The GAAP accounting earnings number, meaning the idea that R&D is not treated as an investment. The idea that stock options are treated as a cash expense, which it isn't. The idea that companies that make any acquisitions, they get destroyed on their earnings, so their earnings look much lower. So we're juicing up that earnings number for all the mistakes that US GAAP accounting makes. And even when we do that, you still have this company at 65 to 70 times multiple, even after we do all those add backs. So it's something you use all the time. It's an e-sign company. And the problem is, it's just really an e-sign company. I know they're trying to expand, and the company's DocuSign, D-O-C-U. The idea that every other company can't build their own e-sign and embed it, again, no real switching costs, no proprietary method or data to it. At the end of the day, you just want to make sure that what you sign gets signed correctly and goes out. Someone should have bought this company years ago, right? And then just put it on their platform. And the fact that it's still out there by itself and it has 70 times multiple, this is a reason not to jump on that one with the dip that we're seeing and to be very, very careful.
Yeah, easily recreatable technology and software. Great points, Joel. Thank you so much, Joel and Rob, for the time today. If you are interested in more stocks to buy and stocks to avoid conversation, make sure to check out this interview I did with Jeff Clark just a couple of weeks ago. He talks about certain sectors, some sectors that have seen a little bit of a pullback in the last few weeks that he says are great buying opportunities. I know software is one of them, but then he lists a really interesting sector to avoid any kind of drop in right now. It's a really great video. Make sure to check out that one too.